All right, welcome back to Trade and Wait. Today, as usual, we will review E-mini S&P 500 futures, utilizing the 4-hour time frame as our higher time frame chart, and we're going to look for setups utilizing ICT concepts, fair value gaps, predominantly breakers, order blocks, if applicable. Wicks, treat gaps like wicks, concepts of the bodies tell the stories and the wicks do the damage. The bodies of the candles is where the bulk of the volume is, versus as opposed to the wicks or the shadows. There's volume there, but it's less volume than the body. Clearly, it's like, it's thin one's thicker just by visualizing that, right? Key support and resistance levels, and also the ideal of price going from premium to discount, aka overextended to overbroad, for example, and looking for opportunities there. For example, this big bear bar here, trading down, taking out one. This is your 3 drives pattern as well. 1, 2, 3 drives lower, taking out liquidity, and then retracing at a very minimum, retracing back into a discount. So in this case, back into premium, but it's a discount if you're thinking about shorts. And you can see that here. Just that range went back above 50% equilibrium. Well, there's that. You could also potentially see this as a breaker block, these 3 down close candles, 1, 2, 3. So we got a high, low, higher high. But it'll be all 3 of these, but we can see if price is gonna hold below here and this continue short lower. We'll see. That's an ideal. Everything else need to generate multiple possibilities for price to go, potentially go, and trade the setups that you have the highest probability of success with or for. So as usual, if you find yourself in a fair fight, you fail to plan, and again, that's for a fair fight. You're not looking to play fair here, right? We going against apex predators. We need to dress accordingly and behave accordingly, right? It's up to you, right? Your money or your life. Your money or your life. It's funny. There's a book by Joe Dominguez and Vicky Robin. I think it's part of like the FIRE movement, Financial Independence, Retire Early. That is literally the name of the book, right? Your money or your life, transforming your relationship with money and achieving financial independence. That's the name of the book. That's the name of the book. That has ideals. Remember Jim Rohn, you're speaking about the book Think and Grow Rich by Napoleon Hill, and he says you want to get rich, and pretty much you want to get rich. They wrote the book and you haven't read the book, right? Like it's up to you, man. However you want to play it. Like, don't play yourself. Play the game. Don't play yourself. All right. So today's Thursday. Officially, today was Thursday. We got 8:30 news, unemployment claims. At moderate news at 12 o'clock, crude oil inventories. Not sure what that looked like in the market itself. This drop didn't occur when the news came out, I'll tell you that much. Let's see. Yeah, I don't need that here. Get rid of that. Let's get the economic. Live. Coming to you live. Economic. Anyway. All right. So that's not for now. That's for later. All right. So the 4-hour chart. Again, yesterday, last night, we did outline the range that price was trading in, right? 1, 2 touches, 3 touches, 4, pull back inside. Yesterday I did highlight, let's see, I did highlight a small fair value gap here. And we can see, like previously, there were more fair value gaps inside of here, for example. I didn't count this one here as well. But we did successfully, logically determine internal range, external range, back to internal range, to external range. We have a failure swing here. We have the bodies, we have price running the bodies of the candles, part of the wicks as well. But we focus on the bodies here, pulling back down into fair value gap, 4-hour fair value gap, then taking out external range again. Then I drew this out and the possibility for price to potentially hold above that. It broke below, ran back above it, and then this massively shifted, right? So here we have, and I think I would side with being bearish for now. Not just because of this, but we have a run. This is the model, right? Run on stops, market structure shift, pull back above 50% of the range that caused the market structure shift. This is displacement. Ideally, before considering this, I would like to go to a higher time frame, but I'm not going to do that right now. That's something possibly for this weekend here. So yeah, it broke below this range that the bottom of this consolidation here, pull back. So I guess to consider, if you were to consider price continuing higher, we want it to hold above this, the bottom of this range that it broke out of. So it pretty much broke, retested the bottom of the range, which is also, like I mentioned, that corresponds with the entry breaker block, high, low, higher, high, and we can take it from there. So we'll leave this here for now, and it should be, let me put it as, we put it, look at it in relationship to price earlier. So we'll make it green for now, and let's just go back and put our fair value, and then we drop to the 15-minute, right? Let's see how price itself reacted to that fair value gap. Let's turn that off. Turn that off. So what can we say here? We can say this is the midnight open. You see that price opened today's price so far as an inside day. So we inside the previous day's range. On top of that, we are also, I think I gotta take that off. We also inside of the Tuesday's range as well. We're back inside, so we inside Wednesday's range, and we also low key inside of Tuesday's range. Right, so right. All right, so we had a run on stops. We have this swing low here. We have a break of that market structure here. We have a retracement here. This is when we were here. We were here for that, but I think we were here. I don't know. Oh, I think I made the last night's video around 9 o'clock, so I don't remember. Doesn't really matter at this point. But we have an imbalance here that was violated. And yeah, so literally Let me see here. We can do this as well. So this is the previous day's high. We have price running above the previous day's high. Let's take this sec off for now. Probably won't put it back on, but that's the previous month's high. And point of this is price ran above. So we got a run on stops. We have some form of displacement here. We have a run below this low here. Right here. Market structure shift. And then we have a retracement back up. Didn't quite reach the high that was broken. It actually touched, ran above the Asia high, which is here. So that's good money. And then it went lower. Got another break in market structure here. Didn't go lower here. Ran the Asia low. This is a consolidation. So we ran the low, ran the high. Break in market structure here. Right, so it ran the Asia low, left the Asia high intact. It just ran buyside here. Slow bleed, consolidation. Run up. This is the pretty much the end of the London kill zone. You can say that's an order block here. Up some. Right, got an order block. And short, and then 9:15. So we have an entry here as well, 6:45. Upward consolidation here. And the news, it didn't do much. It's kind of Judas swing higher. And then 9:30 dropped. And this is that 4-hour fair value gap that possibly was going to be a form of support, but we can see here that it is some degree confirmation of a short position. And that would be that. So you have London creating the high of day, breaking market structure, retracement, and 9:30. So the news caused the Judas swing. Right, so that would be optimal trading tree. Essentially, right? That's the rules. Rules are run on stops. Market structure shift. Run on stops, market structure shift. So you have an entry here on the order block. So run on stops, market structure shift, retracement above 50% of the price leg that caused the market structure shift into this, right? It also consider here, like prior to 9:30, if you wanted to take that trade, that would be an inverted fair value gap. That would be this entry right here, or on this fair value gap, it just returned back to it. Let's see. So then we went short, violated that. The next draw would be this 4-hour fair value gap and these swing lows. So what we did not do. And all right, 12 o'clock was what? 12 o'clock we had that. What I'm thinking is, why didn't this show? Why isn't it showing the intermediate news like it showed like this? Anyway, not that important, right? 12 o'clock was here. So we had the run down, run back up, continuation short. There's no break in market structure here. You may have the idea that, hey, it's consolidating below these bodies here or inside of this wick. Refuse to break lower. This time frame probably wouldn't take this, continue this short here. Or even go long right here. Unless you see like, all right, it's creating higher highs, higher lows and higher highs. That's a reason to get in. This would be your break in market structure here. Retracement into this order block. And let's do this. All right, so you can see mean reversion halfway point. Oh, that's great. All right, and that's that. But the dominant trade here was the short. Targeting previous day's low, Tuesday's low. Also this imbalance here. And traded right back into this consolidation. So yeah, I have like a pet project where I'm like trying to work on understanding price action in relationship to the consolidations, like breaking above consolidations, and then those consolidation areas actually being like key support or resistance areas, right? And that's beside the fact. Like you have like obviously ICT concepts, you would say, all right, there's like a mitigation block here or order block or something like that. But let's just take the general ideal of this is literally like the turning points. It's like literally previous consolidations, right? So this is a previous consolidation. Here you have it here. Hit this consolidation here, or broke above it, retrace back down into here, retrace back up, and then drop. Trade it, retest it here, this consolidation here on this candle, pull back again. Came back up, broke, ran. All right, probably think I'm bugging, but came back up, ran this consolidation area, or traded into this consolidation area and fell. Right? Consolidated again, where? Right? Into this consolidation area, fell. I don't know, B. Like, you tell me, you know something I don't know, put me on, right? Put me on. That's value right there. So, but yeah, let's, I think I wanted to adjust this for better entry because of that wick, right? Kind of like have a working theory about the wicks, especially here. This wick, I guess it's relatively small, so I wouldn't even bother with that one. But this one here, man, definitely got 61.8 entry, and we have at least 3 standard deviations, 3.5 standard deviations of this price range. That's a better risk to reward ratio, and pretty good for targeting, right? My guy named Dexter Lab. Let's see, I think Dexter would do something like this here, right? Utilizing the manipulation leg to determine how far price is going, right? So normally price would go to 1.5 unless you have like a dynamic move, and then there you can start targeting pretty much 3.5 or 4, 3 to 4, I'm not sure, but I think 3.5 to 4 as a target, just utilizing the manipulation leg prior to distribution. So that's just what I got for that. I think yesterday also I wanted to highlight the use of the 4-hour even now, doesn't have much value. As you can see in relationship to the previous, so like opens here, apologies, runs the low, comes back up. So this is now support. Broke back above the previous 4 hours low, held down, retraced back into this candle, took back off into this imbalance. But let's see what this looks like. Right. Let's take everything off the chart. See. So yesterday I wanted to talk in relationship to 4 hour. So this is highlighting the 4 hour candle. So this is 10 to 2 and then 2 to supposed to be like 2 to so it says 13 to 1500, but it's really like 2 to 6. This one says 9 to 1300, but it's the 10 to 1400, right? 10 o'clock to 2. So the yellow ones is the regular market, right? The 4 hour candle from 10 a.m. to 2 p.m. And you can see here that price, like this candle ran the low of the previous 4 hour candle, and then ran the high, then retraced into it, then targeted the 2 to 6 high. Kind of like it also, you could utilize this information in conjunction with what you know already, in terms of the London high. The London high is part of this candle, right? And right, the London low, the PM session low and high is part of this candle, the purple candle, and the AM session high and low essentially is part of this 10 to 4 a.m. candle. This is the, like, there's something, right? Let's turn off. Turn right off, turn off. Let's turn these on. Then we can see at the bottom here, we can see now which, right, and this is utilizing what I put for the kill zones. 2 to 5, 7 to 11, 11 to 1300 for the lunch hour, 2 hours, and 1330 to 1600 for the PM session. And you can see which session has the most dynamic or the largest price run. And you can see here that the AM session has the most potential for price movement. So this is why utilizing the 10 a.m. to 2 p.m. candle is like an ideal, and using it the power of 3 in relationship to the previous candles, aka the previous kill zones as well. So here today we can see that same thing here. Price retrace into the PM session. This is another way. And this is just the 15-minute chart. You can see that. Retrace here, ran the London low, retraced back into itself, so to speak, back into this range. And we have the same short opportunity, utilizing this high to this low for optimal trade entry. Short, taking out these other previous 4 hour candles. It's just an ideal, right? The relationship of the 4 hour candles with each other, and also in relationship to previous session highs and lows, and aka potential draws of liquidity as well. I think that's all I got for now. Feel like I'm done. I'm about to go It's time for some other things, some other business. But I'll talk to you guys another time. You guys stay great. Please like, comment, subscribe. Enjoy the rest of your day. Clickety clink, clickety clink. The money goes into my piggity bank.